Hey everyone, welcome to The Explainer. I am absolutely thrilled to walk you through today's breakdown because honestly, we are looking at an incredibly unique market environment right now. We're going to go on a pretty fascinating journey today. We'll start way out with the massive global macroeconomic data and then funnel all the way down to a highly specific multi-million-dollar options trade happening right under the surface. If you want to know exactly what the smart money is up to while the broader market makes literal history, well, you're in exactly the right place. Let's jump in. So let's get right into it. The S&P 500 just crossed the 7,800 milestone for the very first time. No big deal, right? Well, actually, this explosive growth brings the total market capitalization of the index to a historic $70.8 trillion. To put a number that massive into perspective, if you spent $1 million every single day since they built the Great Pyramids, you still wouldn't even be close to spending $70 trillion. It's a historic high, absolutely. But as we're going to see, the environment driving this whole shebang is incredibly complex. Here's our roadmap for today's explainer. First, macro highs and headwinds. Second, geopolitics shaping energy markets. Third, tech, AI, and market breadth. Fourth, key stock setups to watch. And finally, the multi-million-dollar trade. Starting with Section 1, macro highs and headwinds. Think of this as an economic tug-of-war, because underneath that massive market cap, there's a serious tension brewing in the data. Right off the bat, there's a profound disconnect between market expectations and what the Federal Reserve is actually saying. July inflation data came in slightly cooler than expected at 4.7%. That prompted the CME FedWatch tool, which is the market's main rate gauge, to price in a 65.4% chance of no rate change at the September meeting. Okay, sounds good. But then we have Cleveland Fed President Beth Hammack coming out and saying she wants to raise rates immediately. Her argument? Well, businesses are so eager to borrow and invest right now that she fears this rapid growth is going to put massive upward pressure on prices. So you've got the market expecting a pause, while key Fed voices are trying to slam on the brakes. And this exposes a massive structural headwind. The annualized interest expense on U.S. federal debt just hit a record $1.38 trillion. That's equal to 4.2% of the country's GDP, literally the highest level we've seen since 1997. What's truly wild about this data is that this interest cost has surged nearly 200% over the past 5 years. It has completely eclipsed both national defense and Medicare spending. It's just a massive capital drain happening right alongside these record market highs. The crucial takeaway here is that while the stock market is popping champagne, the average consumer is genuinely feeling the squeeze. When you look at the data on 90-day-plus delinquencies, credit card balances are at 12.9%. That's near the highest level we've seen since 2011. Student loans sitting at 10.6%, the highest since 2020. And auto loans are at 5.5%, which is near a record high. So we've got this intense duality, right? Institutional and broad market highs up top, propped up by extremely low volatility expectations, while consumer debt struggles really start to mount at the foundation. Moving to Section 2, geopolitics shaping energy markets. Beyond the domestic data, rapid-fire global developments are putting immediate pressure on the Middle East. Let's connect the dots on these global developments, because together they represent a highly coordinated threat to the energy sector. First, traffic through the Strait of Hormuz has fallen to its lowest point in 3 months, and that's due to an ongoing, indefinite U.S. naval blockade on Iranian ports. Meanwhile, the USS Abraham Lincoln has been deployed consecutively for over 200 days, which is prompting some serious lawmaker concerns over sailor conditions, while the USS George Washington is en route to replace it. As this naval tension mounts, Iran is moving to join the BRICS New Development Bank to strengthen economic ties with nations like Saudi Arabia and the UAE. Simultaneously, Houthi drone and ground attacks are directly targeting Saudi Aramco refineries. And all of this friction is happening while the U.S. Strategic Petroleum Reserve sits at its lowest level since 1983. The sustained supply chain pressure here is just immense. Let's pivot to Section 3, tech, AI, and market breadth. We need to see what's actually carrying this $70.8 trillion market higher despite those geopolitical and consumer headwinds. Unsurprisingly, artificial intelligence remains a massive catalyst here. Anthropic is reportedly in talks to acquire the AI startup DART for $6 billion. Now, DART develops software that makes AI chips significantly more efficient, which fundamentally lowers the extremely high costs of training and running these large language models. This is Anthropic's largest known acquisition to date, and honestly, it plays out like a highly strategic chess move right ahead of their highly anticipated October IPO. And by the way, that IPO is expected to be the second largest of the year, trailing only SpaceX. The capital flowing into AI efficiency right now is just staggering. But you know what? It's not just a few AI giants playing the weight anymore. 75% of S&P 500 stocks are now trading above their 200-day moving average, which is a classic indicator of long-term trend health. Get this, we haven't seen market breadth this strong in 219 trading days. Historically speaking, when a streak like that ends and breadth improves this drastically, the tech sector gains an average of 33.4% over the following 12 months. That is a tremendously bullish technical signal for the broader market. That brings us to Section 4, Key Stock Setups to Watch. Let's drill down into exactly who is reacting to this wild environment. First up on the radar is Netflix. Bill Ackman just released a highly bullish thesis on them, projecting that when combined with a robust buyback program, Netflix's earnings should compound at nearly 20% annually. He believes their content costs are growing much slower than their revenue, and that drives massive margin expansion. The stock jumped almost 5.5% on this news. Traders are now closely watching it test a very clear critical resistance level right around $78.50. Next, we're seeing some major momentum shifts in memory chip stocks like Micron and SanDisk. These stocks have been trapped in some brutal downtrends recently, but suddenly they're breaking out. Why? Well, they're being ignited by exceptionally strong earnings reports from industry peers like Nabivius, CoreWeave, and SMCI. But remember, these are highly volatile plays. SanDisk, for example, moved a massive 13% into the close just today. The technical downtrends are breaking, and short-term momentum is absolutely pouring back in. Also, take a look at Palantir. Following an incredibly strong earnings report in early August, Palantir gapped up and rallied over 40%. Right now, it's stuck testing a very heavy resistance zone at $180. If it can cleanly break and hold above that 180 level, it creates a massive potential continuation opportunity for traders who love to follow technical breakouts. And if you're a momentum trader, here are 3 highly specific levels you've got to watch tomorrow. First, ARM Holdings. Watch for a clean breakout over its high of $290.15. Second, OKO. Keep an eye out for a push above $47.70. And finally, on the bearish side, ODS got completely hammered on earnings today. If it breaks down below 880, momentum traders will definitely be watching for further downside. As always, these are super volatile, so strict risk management is absolutely key here. Section 5, the multi-million-dollar trade. Let's bring this whole narrative full circle and tie those early macro and economic and geopolitical headwinds directly into how the smart money is actually positioning itself. Let's break down the exact mechanics of this massive play on the XLE, which is the ETF that tracks the energy sector. A trader just utilized a call debit spread, a strategy used to limit both risk and potential return, expiring way out in January of 2028. Step 1, they bought the 60 strike call options. Step 2, they sold or shorted the 80 strike call options against them. In doing so, they are risking a cool $4.44 million to potentially walk away with $10.55 million. Now think back to what we talked about earlier, the Strait of Hormuz, the naval blockades, and the depleted strategic petroleum reserves. This trader is looking at that exact same structural supply disruption, recognizing that the XLE is currently breaking out of a large wedge pattern around $60, and they are betting $4.5 million that energy prices will remain elevated for years to come. It is a massive, high-conviction structural trade. So, as we wrap up today's explainer, I really want to leave you with a question to chew on. With the broader market celebrating record, history-making highs, but operating against a backdrop of rising consumer debt, massive federal interest expenses, and intense geopolitical energy tension, how are you positioning your own portfolio? Are you chasing the AI breadth, or are you hedging with long-term energy plays like the smart money we just looked at? Thank you so much for joining me to break this all down. Stay focused, stay disciplined, and I will see you in the next explainer.